Seen the word inverse or leveraged ETFs and wondering what they are? This is a video that will probably deter you from using them. This is a beginner-focused investing channel, and I think the upshot is, from my point of view, is that unless you are a very seasoned investor, I would not even begin looking at these. And this is a video really to explain why that is. What I've done is I've got up Trading 212. And if we go into inverse ETFs, is often where you see them. You see leveraged shares 3 times short Tesla, meaning basically mirroring a short position that, what you're basically betting on is that the stock will drop, and that's when this offers value. 5 times short, which is 5 times leveraged. And you can get short and long position leverages. But what they're essentially offering is, say, instead of normal ETFs are 1 times leveraged, meaning that it will track the underlying index. If something moves 100%, this will move 100%. 3 times, basically what it's saying is that it will amplify any movement of the underlying index 3 times, and 5x is 5 times. On Trading 212, if you go on to your invest in the top left, you also see CFD, which is contract for difference, and what that is also is a leveraged form of trading that is high risk, and again, not something for beginners really. I think Trading 212 as part of their sign up say that I think it's 80 or 90% of people that open CFD accounts lose money, which I think is a decent way of probably deterring people. And CFD is not really a long-term investment strategy. It's more of a day trading approach. So back into Trading 212 here, looking at the inverse ETFs, these are all the ones that short items. But if you go on the top left and just look up, for example, leveraged, there will be other ones as well, more than just S&P, leveraged swap. And if we have a look, if I go back to the inverse ETFs, what we will see is if we look at the longest time horizon, so max, a lot of these tend to trade all the way down to 0, or basically becoming a penny stock after being a lot more expensive previously. And we're seeing losses of 80%, 67%, 99%, 100%. And why exactly is that? So what's key to remember is that these are amplifying any movements of the underlying asset. And what you think getting to something becoming worth 0 for a regular stock would take an incredible amount of mismanagement or a scandal, for example, for a stock to ever be worth 0 or even anywhere near 0, at least for a stock that was worth a lot before. But if you think about it, if the underlying stock loses 33% in a day, if you have a 3x leverage on that, that is essentially a 99% reduction in the value that you'd expect through a 3x leverage. And what we see, and I think what the last month has shown in the markets, is that losing 33% in a day, for example, isn't impossible, or at least 10 or 15%. And at that point, you're nearly wiping out 30 to 50% of the value of this stock. So I think you can sort of see and imagine from that why these are so risky and not good for beginner investors. These will create vast amount of volatility in your portfolio unless the underlying asset is very non-volatile itself, which very few stocks are. And you have to think yourself, is it worth this amount of volatility? Do you want that amount of risk? What a lot of people think, I think why people use these is they think, I don't want to risk as much capital. Maybe I put in 1/3 of the amount of capital, but have it 3 times leveraged, and that will give me the same returns and exposure. But that isn't strictly true. Something else that I think makes them difficult for beginner investors to probably comprehend is that the way that they work is through options, derivatives, swaps, and the actual to effectively operate a 3 times leveraged asset requires constant rebalancing. So because of that, the expense ratios are also often higher because there's a lot more work to maintain such an asset, which also isn't good really for any sort of long-term growth. But what I'm going to run through is a file that I have on my iPad here, and I'm going to put my iPad down for this, but what it does is it explains something called the leverage trap. And what the leverage trap is sort of what I explained earlier about the way that losses are exemplified. So if we look at this, basically what we have is days, on the far left column is day 0 to 5, which is just showing the 5 sort of trading sessions. This could be any sort of time period. The daily return, so in this scenario, we've got 23% up, 20 down, 20 up, 23 down, 10 up. And in C, what we see is that after this, you would end up back at parity. This is what this document shows, and I will try and link it below. But basically what this shows is how you can start at 0 and end at 0. There's no gain or loss when you 1x leverage. The far column on the right is explaining how a 3x leverage works. And what we see is that they start at 100, they gain 23% in a day, which due to the 3x leverage is then 169. It's also important to say that the leverage doesn't always work, or doesn't necessarily always exactly equal 3x. It depends on the weighting and how it's managed, but it should be somewhere near the underlying index. But we often see that they don't track as well as maybe you'd hope. But we're up to 169. It then loses 20%. And because of that, it loses 60%. And what that means is that the 60% loss is far greater than the 23%, which is 69% gain on the first day. So that leaves you at 67 euros. This then basically continues. And at the end of it, what we end up with is the same losses, the same benefits and losses have happened. But instead of being where you started at $100, you are at 43. And that's due to the impact that the losses have on the nominal value being greater, and then having, say, a 20% gain or 3x leverage on a lower number will not outweigh or will not match the loss on the higher nominal value. And this is the leverage trap, and this is why a lot of these end up trading to zero, because of this. It's the effect that the losses have, and the gains not, when they're leveraged, aren't enough to keep up with the extent of the loss. So this is a little bit complicated, and I'll try and link this in the comment below because it's really good for wider reading. But I think what this does show, and this is really what what I'm trying to get to, is that the leveraged assets are not a good long-term investment for people. Again, this is not investment advice, but this is just me putting my opinions out there. Do your own research, and obviously you can use these in your portfolios if you want to, but it's very key that you understand the risks and understand the trading patterns that these have, because they do not work necessarily as you might think, and there are a lot of risks beyond what is you would initially think by, I just get 3 times the returns. It doesn't work like that in the long run. Well, anyway, I hope this video has been helpful and useful for you all. Again, I appreciate all of the support on the channel, and please feel free to like, share, comment any feedback or future video ideas down below. That'd be really appreciated. But anyway, it's been Harry from HTL Finance, and I'll see you next time.